Yeah, look, I will always say this coming from Prime, you cannot outsource risk. And you cannot outsource, liability. I think in crypto, we often try to bring TradFi to us. It's like, how do we teach them about Web3 and bring them to us? And realistically, what I think is going to happen is we're actually going to come to them and we are going to take their assets and we're going to meet them in the middle. And that's where I think you're seeing a lot of the vault infrastructure providers like ourselves start to build out feature sets that are very, traditional finance oriented because we have to service those users now. That's the next wave. Look, I every single week someone tells me that 2026 is the year of the vault, and I couldn't agree more. And every single traditional finance, organization that has a DeFi desk or crypto desk is looking at vault. Point blank. DeFi works. It has survived multiple cycles, and there's an enforcement mechanism where you don't have to trust some of that, trust me, bro, counterparty risk pieces that you kind of see in the space. Unfortunately, yeah, adoption is real. It's happening. So very excited year for 2026 in Vault.
Most vaults lock you into one strategy type, such as lending, liquidity provision, or basis trading. But what if vaults could be multi-strategy portfolios that deploy anywhere yield exists? Upshift has emerged with a modern thesis. Vaults should become the default way to access DeFi yield, evolving from simple lending to complex multi-strategy products. Their goal is to make on-chain finance as capital efficient as centralized finance. This means building Web3 infrastructure that allows all on-chain financial assets to interact and collateralize against each other through one universal margin account. I'm Dylan Hansen from DIA, and today we're talking with Aya Kantorovich, CEO and co-founder of Upshift Finance. Aya, welcome to Beyond Yield. Okay, Aya, thank you for joining us for Beyond Yield. It's great to have you here. Before we actually get into anything, how's it going? How's your day been?
It's good. It's busy. Despite these markets, it's busy for us.
Good. That's always good. It's always busy means progress. So I think that's always an important thing.
Busy's better than bored, so we'll take it.
100%. So let's kick it off before we get into Upshift in August. Love to get a brief background on yourself, like history of your journey. Where were you before? What were you focused on and passionate about? And kind of what were the market gaps or opportunities that led you to see, to co-found Upshift?
Yeah, so my quick background started my career in crypto back in, I believe it was 2017 at Pantera Capital. And that was during the boom and bust of the ICO bubble, as well as the investment into a number of different liquidity providers that were segregated by geography. And you started, as I was leaving Pantera, to see a bit of that aggregation happening. And so you had a number of local exchanges, but it was still very fragmented to buy and sell Bitcoin, even in size. Impossible to do in size, but also, very difficult to do in your local geo. And so then I joined FalconX, and the goal there was, how do we create this aggregation layer of liquidity so that someone can come in and buy, $10,000, $1 million worth of Bitcoin without crazy amount of slippage. And in order to do that, you had to aggregate all of the exchange liquidity as well as OTC desk liquidity. And so my journey started as part of the founding team of FalconX, built out the sales and trading arm there, as well as a number of different biz dev offerings for the firm and product lines, and left after the company raised its Series D in 2022. I had a lot of concerns with, the way that CeFi is not necessarily transparent, and it's hard to, really understand what your counterparty risk to different firms, and obviously, everything that happened with RWAs posting the same form of collateral across multiple desks, very similar to what Archegos did in traditional finance, was a big red flag. And for me, what I thought and knew to be true was that DeFi works. It has survived multiple cycles, and there's an enforcement mechanism where you don't have to trust some of that, trust me, bro, counterparty risk pieces that you kind of see in the space, unfortunately, come in whenever there's a bull market. So my focus, I got very lucky. I left FalconX a month before FTX happened to double down on bringing a lot of that prime infrastructure on chain, really focus on a smart contract that does cross margin. So how do we take multiple assets, multiple positions, lend against it in a capital efficient way, and make DeFi as capital efficient as CeFi while still protecting that peer-to-peer ness. We raised at an interesting time. It was the week that FTX collapsed and got very lucky, closed a term sheet the following week, and definitely lost a lot of years of my life then. But, it was an interesting time to really double down and build on something that the industry clearly needed, and was just proven true, unfortunately, with FTX. And so it really was, how do we build infrastructure to bring back the lenders in the space? Because at the time, after FTX, people are like, we are not touching this ecosystem. This is absolutely not safe investment. And I would say 2023 was a really tough year to be building in crypto. And so, we built that, scaled, onboarded clients, and we actually had in 2024 clients ask us, "Hey, there's this new thing called Vault with the birth of Morpho that came out, and we'd like to see if we can use your infrastructure for actively managed strategies," because Morpho was more focused on isolated lending, single protocol, single asset, where we are multi-protocol, multi-asset, multi-chain. And so that was a really big focus for us. We came to market in 2025 with Upshift, with Kelp, which was a really great partnership. Learned a lot, grew a lot. They're a fantastic team, and was able to scale that from 2025 launch to over 550 million in TVL at peak in Q4. We're roughly flat on that, I think around the 400 mark since, given markets and pricing. And yeah, it's been really a tremendous journey in just figuring out, I would say last year, the focus for us was really protocol and ecosystem vault. And this year it's all been institutional.
Yeah, excellent. I think that's really unique to your positioning. Is the multi-strategy approach that Upshift takes, right, in vault curation, and this is directly tied to the connection between Upshift and August. So, as I understand, Upshift is more on the retail side. August is more supporting on the institutional facing side. Can you share with us a high level as well as the organizational structure of both of these?
Yeah, absolutely. So we have a team that's focused on August, and really the process there is a client comes to us if they're looking to trade over 250K in size, typically looking to borrow against an asset, and then looking for ancillary prime services, so trading, execution. And so they'll go through a full KYC, KYB process. We will either, find them some sort of on-chain liquidity to lend against those assets. Within their portfolio that's closed in a closed ecosystem. So over collateralized lending, very similar to a Maple structure, but over portfolio of assets versus isolated single assets. And then for the other side of the lending, we will connect them with other lenders who are comfortable with their infrastructure and can lend against those assets as well. So I would say that is on the August side. The underlying risk engine monitors for both. So we have integrations because we need to be able to calculate the equity of a position and also be able to run liquidations. We're able to analyze over, I think today we have over 800 assets across 35 blockchains and over 100 protocols where we can calculate the price of that asset at any given point in time. We have a risk ladder that calculates liquidation and secondary liquidity for those specific assets, always being most conservative. And so that ports very well into Upshift, which then is also focused on NAV calculations, vault and equity, P&L calculations, and so forth. So you get a lot of seamlessness between the two just by the nature of the underlying calculations.
Yeah, there's a lot to dive into. I want to go deep into your outlook on RWAs and tokenized assets that you mentioned you guys are now very much focused on. But I want to take a step back, and one thing that's always interesting for me is, and I'm asking a lot of teams, this is, to what extent is all of this due diligence done in-house versus relying and utilizing external third-party infrastructure, resources? Like you just mentioned, so many different, over 800 assets you guys are constantly monitoring and analyzing the yield, the NAV, redemption, redeemability of assets. What does this look like kind of behind the hood for you guys as it relates to the due diligence process in-house versus also utilizing what's available through third parties?
Yeah, look, I will always say this coming from Prime, you cannot outsource risk. And you cannot outsource, liability of, something going, not being priced properly or not having the proper secondary liquidity. And so one of the things that we look for example, on the vault side, when we look at different curators or vault strategies, deposit assets, and so forth, is what is the secondary liquidity for that specific asset? If we think, vault's going to go from, for us, the minimum is at least like 50 million, but let's say call it starts off with 10 million. What's the on chain, secondary liquidity for that? Also, what is the concentration risk of the wallet holders of that specific asset? Are we able to have direct mint and redeem
Yeah.
with the company? And then the other thing that we look at is we also leverage a lot of the prime desks and their compliance teams. And so we can ask different exchanges and different prime desks that we're onboarded with, hey, do you service this asset? And typically the answer will be yes or no. Here's, kind of the overview from their compliance team as to why. And so we go through a lot of that due diligence. And honestly, that helped us avoid the stream finance situation. So, we knew the team. We didn't work with them on a vault. We also didn't have any of our vaults exposed to stream assets nor Elixir assets. And so, all of that was very intentional. And so when we think about recursive looping and especially on some of these assets that aren't necessarily not even like tier one, tier two, tier three, but just completely at the bottom of the barrel, long tail assets, that's really important because at the end of the day, when you platform these specific tokens, assets, strategies, you are marketing them inherently to some sort of user, right? And so at least we take the position that you take on some responsibility when you do that.
Absolutely. And when you're referencing liquidity here, you're looking at on-chain liquidity, of course. But to get back to your kind of what's next for you guys, as we look into tokenizing assets, private credit, and other types of demand for like traditional financial assets being brought and utilized on chain, how does that look from a liquidity perspective? You can't really have on-chain liquidity for private credit, as I high level understand it. So how are you guys looking through that?
Yeah, look, I think there are things that should be tokenized and things that should not be tokenized. And this goes back to like, 2018 ICO cycle, right? When there are things that are natively digital and belong on chain. And then, you struggle in general when you take something that is traditional finance or not digital and try to tokenize it and bring it on chain into a 24/7 market, right? You get duration mismatch, you get liquidation unlock issues, you get zero secondary liquidity. And then you try to put a 24/7 lending market on top of it, and so obviously you're going to have a lot of issues just naturally with that. And so one of the things that we've been exploring is realistically, like, we view lending as a very initial first step and clear product market fit for crypto. In that, if you look at over collateralized lending in the traditional market sense, it's a very small percentage of overall markets. Larger markets is the repo market, short-term repo. So if you think about it, it's people trying to get in and out of assets overnight, over weekends. This is just assets that don't trade 24/7. Ideally, these assets over time will be printed, tokenized, traded, et cetera, on chain, but that will take time. And so really realistically, what needs to happen is there needs to be a true short-term repo facility, an instant redemption facility on chain for these specific assets until we get there. And that's something that we're doubling down on. I think because of our prime background, we think about these financial primitives inherently in terms of how do you safely trade something in and out in size, right? And we're not talking like $10,000 here and there, but how does an institution who wants to trade tokenized equity basis, how are they able to do that when the 24/7 liquidity per ticker is $5 million? You obviously have issues with a 9 to 5 trading asset, 9 to 4 trading asset, trading 24/7 on perp market. How do you solve some of these very interesting liquidity needs? And so we are working on that. Whether you call it a vault or really just a smart contract that's enforcing the liquidity for those assets, the nomenclature, I think, doesn't really matter, but we are really doubling down on those financial primitives. And it all really starts, taking a step back to your question, you have to securitize and tokenize those assets, but you also have to figure out who wants to trade these assets and why. Do they not
Right.
already have access to it today? And if they don't, is there outsized demand for those assets? So something interesting that's come up this week in just conversations we've had, people, yes, they want US equities because maybe they can't get access to them, but they also want local equity markets. So whether specifically in Asia. They also want, specific fund structures, ETFs, index funds. Like, we're finally getting to that level of curation. And I think that's going to be very, very interesting for this next wave of institutionalization.
It's really exciting, and I'm always curious, kind of what from your internal perspective dictates whether or not to include an asset from the curation side. Like what do you think? leads to the decision for curators to include an asset within specific strategies or not? Is it demand for capital efficiency for these assets, as you just suggested? Or does it go deeper than that? I'm always curious, like, what are the leading kind of criteria behind decision making behind for curators?
Yeah, I mean, look, we work with some truly excellent curators out there who have an entire risk framework for underwriting every single asset that they touch. And, to a point where sometimes we're asking them to support an asset and they're like, absolutely not. So that is a really good push pull that you get from, a BD team and a risk team.
Yes.
But I would say, a lot of it is very similar to what I mentioned in terms of the risk underwriting that we do. And they go a little bit deeper. I would say there are some curators that are exceptional at private credit and just credit markets. And so they're constantly looking at wallet concentration. They're looking at having direct relationship with each of the individual teams. Like I said, direct mint and redeem, and also understanding, like specifically on the smart contract sense, how is the company built, once the underlying equity yield and corp structure of each of these assets. And then we have, clients who are, or curators that are exceptional at, aggregating curation across number of, chains. And so for us, by in the nature of being multi-protocol but also multi-chain, by supporting 35 chains, I believe we're the only ones that are live on Solana today. We have to partner with curators who are also equally exceptional at being able to underwrite all of the risks across these different chains. And so, yeah, we're very lucky to work with some exceptional curators. I know it's always a very spicy market. Curators will try to compete for a lot of these deals, but the market is huge, and we think there's room for everyone. And there's definitely niches of curators who offer really exceptional, unique strategies for certain asset types.
Yeah, I want to spend some time to go back into Upshift as an institutional grade infrastructure platform, essentially, for not only August but curators to come and deploy vaults. We had a quick chat about this before we jumped on here, but I always find it to be an interesting discussion, to put it like that, between the security requirements, or rather, who's responsible for the security, whether it be the vault platform itself or the curator themselves. The trade off there between responsibility is super interesting. You see that there is permissionless, very open source, essentially, markets on which curators can come and list anything. How do you guys look at this, especially with such an institution focus?
Yeah, it's a really great question. And I'll actually break it down into two-party versus three-party relationships. Two-party relationship is between the curator and the infrastructure provider. And on the two-party relationship, the infrastructure provider is technically the one that's responsible for deposit flows in and out, making sure that redemptions run properly, integrations into all the underlying chains and protocols are seamless. And then, of course, NAV calculation is very, very important and very differentiated. Most vault providers that we've seen do self-reported NAV, which we think is pretty insane. In traditional finance, you would never have the fund admin be the same as the trading desk. Those two have to be separated. So I would say those fall under the jurisdiction of the infrastructure provider. Now, there's also the question of all of the things the curator is trading. For example, whether or not those fall within the regulatory requirements of the infrastructure provider. And of course, also if it runs through just integration, nav, and risk of the infrastructure provider. I will say I think we tend to be a little bit more hands-on in our approach to whether or not we think a curator should touch a specific asset. Again, to be fair, we have worked with curators that are equally on that same risk caliber as we are. So there has rarely been a time where a curator has brought us an asset and we've said, no, we actually do not agree with this. And we think that this fails a compliance and risk review, and here's our reasoning for why. And so we're not going to be comfortable being able to put this on the front end in the specific vault. But again, like I can say, it has happened on less than 5 times, and so we really pride ourselves in the curators that we work with regards to that. Now, when there's a three-party, that's where it becomes a little bit trickier, because you're working with the curator, the infrastructure provider, and now a protocol or ecosystem. And typically, the vault itself is created as an ecosystem vault, which is meant to provide liquidity to the ecosystem and really like help stand up secondary liquidity markets, on lending desks, other, ecosystem report codes. And that's where it gets a little bit trickier, because typically with these vaults, you do not want to be more than 20 to 30% of the liquidity in a pool, because suddenly you are the concentration risk. And so in a lot of these instances, you'll get direction from these protocol and ecosystems, which will say, hey, we want to direct and be now 100% of this liquidity pool. And I will say that's typically where you get a lot of push pull between the infrastructure provider, the curator, and the protocol. And it really depends on what the structure is there and kind of who holds the responsibility for underwriting the smart contract, the due diligence on the team, as well as driving the decisions for those specific, call it investments or asset allocation. And so I would say that's where it's been a little bit trickier, but and that's at least where we've had to get a little bit more involved.
Yeah, very clear. I think that's super exciting, and one of the things you touched on that clarifies for me is that you're working very specifically with certain curators. It's not just anybody who can claim to be a curator that can list a creative vault on Upshift. This is a select due diligence process even into the curator themselves. Is that correct? That are essentially creating vaults on the platform.
Yeah, that's exactly right. I mean, look, we have to KYC the team. We have to know the team. We take rough, checks on them. We have to actually see that they've traded something historically in the past. We actually typically, for all of the vaults that you see on our platform, there'll be a sandbox. They have to test it. We have to make sure that there's actual historical P&L for those specific strategies. And then we will scale them up until we will actually list it on our front end. And so, yeah, I mean, look, transparently, that's what saved us with Stream Finance. We had a member of the team asked to be a curator on the platform. We were not comfortable with that individual's, background and experience, and weren't comfortable at all with this recursive lending strategy. And yeah, I think, look, the downside is that you haven't seen our TVL go from whatever it is and call it like 3-5x, but the upside is that our TVL also hasn't gone down 5x as recursive lending blew up. So I think by being sticky and having non-mercenary capital, it also really differentiates us in the distribution conversations that we're having, in telling users and these different partners, hey, we have sticky capital, and the strategies here are not ones where you're just going to go to whoever throws more incentives and more coins your way. So I do think that's another differentiation that we'd like to think of.
Mm-hmm. One of the aspects you touched on is that vaults, ERC 4626 is not new, but it's recently gained such prominence, right? In the last 2 years, the curators TVL grew from, I think, 46 million to roughly today 7.1 billion. Huge growth. I think it's kind of an argument that these vaults are the flagship DeFi product for bringing institutions on chain. Based on your positioning, it would suggest that you believe this to be the case. But I want to dive deeper into this. Do you, when you're having institution facing conversations, do you find that all the tooling and the transparency, the education, everything that's needed is available for them, or are you still experiencing blockers as it relates to just basically Web3 infrastructure, Web3 awareness? Do you essentially feel like the floodgates are open for institutions and it's just now a matter of onboarding, or that you still have blockers in some of these conversations?
Look, every single week someone tells me that 2026 is the year of the vault, and I couldn't agree more. And every single traditional finance, organization that has a DeFi desk or a crypto desk is looking at vaults, point blank. So what I will say is, where is the infrastructure? A vault today is a very commoditized asset, right? It is just a deposit and withdrawal flow, as you mentioned, just a smart contract for that. Now, what's interesting are the modules that kind of sit around that create the customization. And so I would say, like, where, for example, we're building towards is, gap accounting, reporting and analysis, being able to share our like NAV reporting with, a top accounting firm like a Deloitte, a KPMG, and being able to really go through that and accept it. And so, I would say that's really where a lot of the work is being done this year. And, again, it's why vaults? The reason is it is cheaper and operationally more seamless to run these strategies in a vault versus doing it with the operational overhead that is required in the traditional sense. And so it really is, in a way, a very unsexy but more seamless way to squeeze the costs that a lot of these managers have when they produce these assets and share them and distribute them. And what I will say is today, I think roughly 50% of liquid financial assets are sitting in managed accounts. So it is a very big market in terms of the user base that does not want to actively trade their own assets. The Robinhood user will always exist, and we may see that number go up and to the right. But for the most part, Robinhood just added banking. People want their funds managed, and so I definitely think we're going to see more of that.
We're also seeing, and love to get your insight on this, teams like Fidelity posting hiring job descriptions for DeFi strategists for curation. So we're seeing more traditional financial institutions look into this space. Love to get your thought on this as you see the competition evolving here. Do you think that what types of strategies or assets do you think that these institutions will be interested in? Do you envision them going as deep into traditional crypto native tokens as current curators do, or like do you see kind of a separation here, or that this is just becoming obviously more competitive due to the growth of this vertical?
Yeah, I would say, look, if Aave and Morpho rates on stables right now tell you anything, is that there's way too much cash and not enough use case on chain to be able to put that cash to work, right? And so realistically, I don't think that Fidelity is going to come on and start to do like yield farming and recursive lending and point arbitrage. What I think will likely happen is they're going to tokenize their existing assets. Real world assets are going to come on chain. They're going to use platforms like Securitize and Superstate. And then we'll get true repo markets. We've already seen huge demand for tokenized basis on equities, commodity demand. And so I think we'll just see these slowly come into the on-chain markets and also just become 24/7 and more readily available. And so I think in crypto, we often try to bring TradFi to us. It's like, how do we teach them about Web3 and bring them to us? And realistically, what I think is going to happen is we're actually going to come to them. And we are going to take their assets and we're going to meet them in the middle. And that's where I think you're seeing a lot of the vault infrastructure providers like ourselves start to build out feature sets that are very traditional finance oriented, because we have to service those users now. That's the next wave. And so, yeah, I don't think, I mean, let's see, that will be my 2026 bet. I don't think Fidelity is going to be a DeFi degen trader, but I'd love to be proven wrong.
No, I think that's probably a pretty safe bet there. And I wanna take a look at this through the lens of the multi-strategy portfolios that Upshift and August effectively enable here, and dive deeper into this perspective of curators within this. So are you seeing that curators are really taking advantage of this in effectively implementing multi-strategy portfolios as it relates to exposure to different asset classes, not just crypto tokens, right? But literally taking advantage of multi-strategy or multi-asset exposure. And for like the common Web3 user here, can you explain kind of what the edge is here? Does this increase yield? Does it hedge risk? Kind of what are the benefits of collectively having a portfolio that's more exposed and agnostic to the underlying asset class which is within it?
Sure. Yeah. So we actually ran this review, and I spoke to a very large exchange treasury manager yesterday who confirmed it, which is if you take stable coins and you lend those stable coins against Bitcoin and ETH, if you were to do it on mainnet with single protocol versus if you were to do it on, let's say, Morpho, Aave, Camino, and Jupiter, you would actually get a 2% higher yield return on the diversified portfolio, as well as a 40% less variable rate. And that is very important. And so, at the end of the day, there's a reason why you want to have a risk adjusted return. And it's because you don't want single protocol exposure, you don't want single chain exposure, and you also don't want single rate variability exposure. And so, it really does help having the diversified exposure. And for us, it's so important that we are live on all of these different chains, because there are uniquely some assets that are launching on just specific chains. They're not fully cross chain yet. And so by being the bridge and working with curators who know how to trade across those different chains, and having the risk systems to monitor risk across those different chains, is a big differentiation, both for us and then for the curators we work with.
Yeah, so a little bit outside the main wheelhouse here, but how are you envisioning chain expansion? Like 2 years ago, every new week there's a new chain. It's an exciting time in that regard, but capital is being consolidated. Users are arguably being consolidated. What's your outlook for how you mentioned you guys are supporting, I think 27 different networks.
35 now.
35 exactly. How
35.
what's the future look like for within your kind of expectation here? Do you guys see that there's continual new opportunities amongst many chains? Do you see this consolidated? Where's the industry of kind of multi-chain heading?
Yeah, so look, I do think the future will be multi-chain. I think everyone always thinks that that we will consolidate to Ethereum, and I'm not actually sure that's true. It is very, very hard, and look, we've seen this with everything that's happened with the Ethereum Foundation over the last, call it, 1 year or a couple months. It is very, very hard to double down a team, focus on growth, focus on adoption, and tailor to a specific subset of users. And so, we've seen chains that have built exceptional products for PayFi and remittances. We have seen, and trade financing. We have seen, blockchains that have done an exceptional job with gaming. We've seen blockchains that have done an exceptional job with private credit, and that's their niche. We have seen blockchains that have done an exceptional job with, really high latency trading and HFT type tooling. And so I think at the end of the day, and some for RWAs, at the end of the day, you will still have that separation based off of where a chain's really doubling down on and what their feature set is best suited for, because it's not always the same across these different companies and niches. And so being cross chain is just going to continue to be most important. Now, from the user perspective, I don't think they care, right? And so when you think about how do we always talk about this, how do we abstract that layer away? And the crypto experience is the worst UI ever. We still have not managed to do it. And so really what I think is going to happen is you're just going to continue to plug into more of these distribution paths, which is exchanges, neobanks, wallets, and they will be the abstraction layer. And then on the back end, you'll have, infrastructure like us that are really operating the pipes to allow you to do that. Very similar to, FalconX, which abstracted away all the liquidity pipes across OTC desks, exchanges, prime desks, whatever it was, high net worth individuals, and could plug their liquidity into like a PayPal. So it's just an abstraction layer. So I think it's very, very similar, but for more on chain assets.
I completely agree with that. I'm seeing more and more in the everyday discussions, kind of distinctions amongst chains, unique architectural designs, and decisions of moving or pivoting away from just general agnostic, all use case type of smart contract platforms. So I think it's really exciting to see this, like you suggested, kind of like the verticalization of individual blockchain networks, whether it's RWAs, stables, HFT, kind of like Solana. Well, I guess Solana's done quite well at. I don't want to narrow them into one category because they've actually disproven that argument. So they've done quite well with RWAs and a bunch of the
It's okay. That's who I had in mind for HFT too. So don't worry, you're spot on.
Okay, well, I've been like super impressed lately by the amount of teams moving over to Solana in the RWA space as well. And so you touched on Solana as one of the arguably the only platform that's supporting this right now on the curation side. I would
say, look, I would say Solana's not the only one. There's a lot of other blockchains that are making a push here. Monad, Stellar, Ripple. These are, they have a number of really cool things in the works that will be announced this year, but everyone has a specific angle they're focused on, right? Ripple has Ripple Prime within Road. And so, their bread and butter is margin, lending, and cross margin. And so how do you double down into that and then unlock XRP as a yield source, which is an asset, so many retail folks have. And then, Stellar's really doubling down in PayFi and trade financing, remittances. I mean, it's been phenomenal and such a fun experience to see, to your point, that verticalization. But yes, I agree with you. Solana has done a really good job as well.
Also, Tempo mainnet today. So
Yes.
interesting there.
Yes.
We're seeing, and not to go too off topic, but we saw Cathie Wood announce that she's joining the board of Zero, the network that Layer Zeros has announced. So also interesting to see the backing of TradFi personas, like well reputable people within the TradFi space, actually expressing a vested interest in some of these networks. Um, but nonetheless, I think I wanna kind of wrap and say, first of all, thank you for joining us. Like a wealth of information. I'm gonna rewatch and digest a lot more. I assume here, and I want to also ask you if there's anything we missed. I don't want to cut over anything that you want to highlight on Upshift or August that we might have not dove into.
No, I think, look, you were spot on. So exceptional questioning. We really think of ourselves as multi-chain, multi-protocol, but then institutional. And how do we bring, the vault infrastructure to build other financial primitives? We're excited to be on Solana. We're excited to be on a number of other chains. This will be a big year for us on announcements. And then shout out to the Layer Zero team. All of our tokens are OFTs. Big fans of what they're
Nice.
doing there too. So
Yeah,
yeah, it's been fun to work with other teams that are just really grinding it out and going after the multi-chain thesis in the way that we are. And yeah, adoption is real. It's happening. So very excited year for 2026 in Vault.
100%. It's great to have optimism. I love it. Actually, it's funny. Like at the crypto, I was in ETH Denver a couple weeks ago. It was a very kind of bearish sentiment, and I find it a very interesting dichotomy between Web3 sentiment and institutional facing sentiment. It
Hmm.
seems like you see what Cathie Wood and some of these kind of larger institution people are saying, and they're very bullish. But Web3 sentiment is like, oh, we're in a bear market for a couple months, so. I think I'm personally an optimist on kind of the structure right now. And great to see vaults and curation as a tool to bring in more adoption, accessibility to users, and not just crypto native tokens, but multi-asset strategies. So thank you for joining us. Last thing I've got for you is where can people go to like kind of keep up with what's coming for you guys and explore the vaults?
Yeah, absolutely. So my Twitter is Aya underscore Cantor, Kantor. And then I believe I should know this off the top of my head, but Upshift Finance is our Telegram for Upshift as well. And then upshift.finance is our website. Please engage with us in Discord, Twitter or X, whatever it might be, Telegram. We also have a Telegram chat. So love to hear feedback from users, always looking to build new things. Definitely reach out. And if you're interested in vaults, tech, or whatever it might be, and we're always hiring. So if you want a job in the 2026 year of the vaults, definitely looking to bring folks on board.
Nice. Well, Aya, thank you so much. Thank you for joining and diving deep with us today. And thank you for everybody who tuned in to this episode of Beyond Yield. We'll see you on the next one. Cheers.
Thanks.